In Part A, analyze and interpret the performance of Bulletin in the following categories. First, profitability, and then social and environmental. All right, guys, so if you need to analyze and interpret, the analysis is going to be your calculations, and the interpretation is obviously your commentary. Now, you can see I have clearly indicated how many marks are available for everything. So for the profitability ratios, there are 5 marks available for calculations and 10 marks available for the commentary. And for social and environmental, there are 2 marks available for calculations and 10 marks available for commentary. Then there's 1 mark for communication skills, and that is awarded for logical arguments. Let's start with profitability. So firstly, what profitability ratios are you going to calculate? Go back to the information provided in the scenario and always use that to help you decide on which ratios you should be calculating. So we were given an extract from the statement of profit or loss and other comprehensive income. So first we have revenue. Now guys, you can always calculate a movement in revenue so that we can determine whether revenue has improved or deteriorated from the prior year to the current year. So we'll definitely calculate a movement in revenue. Then because raw materials used and other operating costs have been separately disclosed and they are both significant costs, we can calculate a movement in each of those costs as well. Now, as an alternative, instead of calculating the movement in the costs, you can calculate the cost as a percentage of revenue. So take the raw materials used and divide by revenue to get the cost as a percentage of revenue. Now guys, you shouldn't perform both of the calculations. You shouldn't calculate the movement from the prior year to the current year and also calculate the cost as a percentage of revenue, because both of those things tell us exactly the same thing. So either perform one of the calculations or the other. Then for operating profit, we can also calculate the movement from the prior year to the current year. And in addition to that, we can calculate the operating profit margin by taking operating profit and dividing by revenue. Then for dividend income, guys, dividend income is really insignificant. And in addition to that, if you go back to the required, you can see we only have 5 marks available for calculations. So it will be very easy to perform enough calculations to score 5 marks. So don't waste time on costs that are insignificant. So we won't do anything with dividend income over here. For finance costs, we can't calculate the effective interest rate because we don't have interest-bearing debt. So we can't calculate anything for finance costs. What we can still calculate is the movement in net profit for the year, so the movement from the prior year to the current year, and we can also calculate the net profit margin by taking net profits and dividing by revenue. So that will be enough calculations to score full marks for this part of the required. Now, if you go to your lecture notes where we covered all of the profitability ratios, I just want to discuss the reasons why we can't calculate the other profitability ratios that are in your lecture notes, apart from the fact that there's not enough marks available. So even if you could perform the calculations, guys, obviously limit your calculations to the 5 marks. You don't want to waste time performing calculations when you need to actually get or move on to the commentary. So for operating cash flow to operating profit, we can't perform that calculation because we don't have cash flow from operating activities. We can't calculate the degree of operating leverage because in order to do that, we need to know what portion of the costs are fixed and what portion are variable. We don't have that information, so we can't calculate that. We also can't calculate earnings per share or headline earnings per share because we don't know the number of shares in issue. All right. So our calculations are limited to the calculations that I discussed with you now. And all of these calculations are very straightforward. So I'm not going to waste your time writing everything out. You shouldn't have any issues marking yourself to the suggested solution. Remember, guys, if we are trying to calculate a movement, we take the current year amount, we subtract the prior year amount, and we divide by the prior year amount. So for all of the movements, you're following that logic. Then in order to calculate margins, so for example, the operating profit margin or the net profit margin, you just take operating profit and you divide by revenue. Or you take net profit and you divide by revenue. So these are all very straightforward calculations. you should definitely not have a problem with any of these calculations. So what I want to focus on in this recording is the commentary, because that's where most students struggle. Now you'll remember, guys, I've given you a framework when it comes to the commentary of ratio calculations. First, you need to interpret the ratio. Then, after interpreting the ratio, you are going to compare it to a benchmark. So compare to the prior year, compare to a similar listed company or industry averages, etc. Then after that, you are going to discuss potential reasons. And finally, where performance is negative, you can discuss the impact and remedial action. In other words, what effect will it have on the business and how can it be corrected? All right, then you will also remember from our lecture, I said to you, when it comes to the interpretation, with profitability ratios, the interpretation is pretty much self-explanatory. The movement in revenue is the movement in revenue. The gross profit margin or the net profit margin or the operating profit margin, those are all margins. There's no interpretation necessary. It's self-explanatory. So there won't be any marks awarded for the interpretation of these ratios over here. And you'll also remember I said to you, where there's negative performance, you can discuss the impact and remedial action. However, you should not force it. And you should only do this if you can add extra value. If you don't have anything valuable to say, don't waste your time. So most of the marks are going to be awarded for comparing the ratio to a benchmark and discussing potential reasons. All right, so let's start with our discussion. First, you should have calculated the change or the movement in revenue. And you should have calculated that revenue has decreased by 1.29% from the prior year to the current year. So, first we need to compare that to a benchmark. Now, already we're calculating or we're comparing the prior year to the current year. We can see that revenue has dropped from the prior year to the current year. So that's the benchmark that we're comparing this to. But remember, guys, you need to use the correct words here. We can't just say that revenue has decreased by 1.29% from the prior year to the current year. We need to say that revenue has deteriorated. Or if you want to say that revenue has decreased, you need to say it's decreased, and this indicates negative performance. Or you need to say that revenue is worse in the current year because it has decreased. So you need to show that you understand that a decrease in revenue is obviously negative. So make sure that you use the correct terminology or the correct words. Then we need to give potential reasons. Now guys, 90% of the time, the reasons are going to come directly from the scenario. So let's go back to the information provided in the scenario and see if we have been given reasons as to why revenue would deteriorate from the prior year to the current year. You'll remember we were told that as internet costs decline and accessibility improves, more people are using online media platforms, and that poses a significant threat to the print media industry because obviously they are buying less printed magazines and newspapers. So that's one potential reason why revenue could have dropped from the prior year to the current year. We also know that the state of the economy worsened over the second half of the current year, and this severely impacted demand. So we are dealing with a tough economic environment. And guys, where we have a tough economic environment, that means people have less money available to spend. So if they have less money available to spend, they're going to be buying less newspapers and magazines. So that's had a negative impact on sales volumes and demand. So that will obviously also be a potential reason as to why revenue has decreased from the prior year to the current year. Then next, you should have calculated the movement or the change in raw materials used. and you should have calculated that there's been a 6.88% increase in raw materials used. Now remember guys, raw materials is a variable cost, so it should vary with sales. And if revenue is decreasing, variable cost should also decrease. So the fact that the raw material cost has increased when we have a decrease in revenue indicates negative performance. Then as an alternative, instead of calculating the movement in raw materials used, you could have calculated raw material as a percentage of revenue. And if we look at the interpretation over here, you can see that raw materials as a percentage of revenue has increased from the prior year to the current year. In the current year, raw materials are a higher percentage of revenue. And this tells us the same thing. It tells us that your raw material costs are increasing at a faster rate than what revenue is increasing. And that's why it's a higher percentage of revenue. So this indicates negative performance. What is a potential reason for this? We were given more information relating to raw material in Note 2. And you'll remember we were told that all paper is imported from the USA. And we identified this as a negative risk, or a negative factor, because it exposes the company to currency risk. And we know, guys, that the rand has devalued against the US dollar. So obviously, as a result of that, the cost of imported paper has increased. And that's why this ratio has deteriorated. Then next, you should have calculated the change or movement in other operating costs, and you should have a decrease of 5.12%. So obviously, if operating costs are decreasing, that indicates positive performance, especially because the operating costs are decreasing at a faster rate than revenue. So that indicates good cost control. And once again, as an alternative, instead of calculating the movement in other operating costs, you could have calculated operating costs as a percentage of revenue. And you can see that operating costs as a percentage of revenue has decreased in the current year, indicating positive performance because your operating costs are a smaller percentage of revenue. So once again, it tells us the same thing. It tells us that operating costs are decreasing at a faster rate than revenue, indicating positive performance, which is obviously as a result of good cost control. And we were given more information relating to other operating costs in Note 3. We were told that other operating costs include directors' remuneration of 10 million in 20X6 and 8.5 million in 20X5, and due to the deterioration in performance, the directors agreed to salaries which are 20% less than market-related salaries in both years. So guys, you can't use this as a reason. You can't say one of the reasons why operating costs have improved from the prior year to the current year is because the directors are taking lower salaries. In both years, the directors were taking lower salaries. So this can't be used as a reason for the improvement in operating costs. Then next, you should have calculated the movement or the change in operating profit, and you should have got a 21.48% decrease. Then you should calculate operating profit margin for each of the years, and you can see the margin was 7.25% in 20X5, and it decreased to 5.77% in 20X6. Then you can calculate the change or the movement in net profit, and you should have a 20.94% decrease. And for the net profit margin, you should have calculated 5.21% in 20X5 and 4.17% in 20X6. So you can see that both operating profit and net profit have deteriorated from the prior year to the current year, and both margins have also deteriorated from the prior year to the current year. So despite the fact that they had very good control over their operating costs, that was not enough to offset the increase in raw material costs and the decrease in revenue. And overall, profits and margins are down. What is a potential reason for this? you were told in note 1 that competitor activity intensified as a result of the decline in demand. So because of the decline in demand and the drop in sales volume, competitor activity intensified. So there was an increase in competition. So the problem with that, guys, is obviously if there's a lot of competition, Bulletin can't just charge whatever they want for their newspapers and magazines, because if they're charging too much, then customers are going to go to the competition, especially where we are dealing with a tough economic environment. So the fact that the raw material costs increased because of the price of imported paper increasing, they couldn't pass the increase in the raw material cost onto their consumers through a higher selling price and try and recover that, because of the fact that they were dealing with a highly competitive environment, and that would have had a negative impact on sales demand because customers would have then just gone to the competition. So because of that, it's had a negative impact on profits and margins. Then, there's one other thing that you can discuss over here. For the operating profit margin, we calculated that Bulletin has an operating profit margin of 5.77% in 20X6. Now, this can be benchmarked to the industry average, which we were given in the scenario. You were told that the average operating profit margin for the industry is 5%. So, although the operating profit margin has deteriorated from the prior year to the current year, it is still better than the industry average. And we do have a potential reason for this. If the directors of Bulletin have agreed to salaries that are 20% less than market-related salaries, and if all other companies in the industry are still paying their directors market-related salaries, then obviously this is a potential reason as to why Bulletin's operating profit margin is better than the industry average. So just be careful when you are using this as a reason. It can't be used as a reason for the improvement in other operating costs, because in both years the directors had lower salaries. However, it can be used as a reason as to why Bulletin has performed better than the industry average, because we are assuming obviously that all other companies in the industry are going to pay their directors market-related salaries, unless we have any other information. So if they are paying market-related salaries and Bulletin's directors are taking salaries that are less than market-related salaries, that could be a potential reason as to why Bulletin has a better operating profit margin. All right, so that deals with profitability.